Dear viewers, you are watching YouTube channel ETV 786. This channel is created and designed for business students. I am your host Muhammad Asif Jaja. You are already watching number 1 basic concepts of accounting, number 2 business law, number 3 business taxes, number 4 business management, number 5 business mathematics on this channel, and now we are presenting number 6 insurance and its types. Please view, like, share and comment the videos and subscribe the channel to view upcoming lectures. So let's start the course number 6, insurance and its types. What is insurance? Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. The company pools clients' risk to make payments more affordable for the insured. Insurance policies are used to hedge against the risk of financial losses, both big and small, that may result from damage to the insured or her property or from liability for damage or injury caused to a third party. 3 determinants of the policy. In order to select the best policy for you or your family, it is important to pay attention to the 3 critical components of most insurance policies. These components are number 1, the deductible, number 2, premium, and number 3, policy limit. Number 1, deductible. The deductible is a specific amount the policyholder must pay out of pocket before the insurer pays a claim. Deductibles serve as deterrents to large volume of small and insignificant claims. Deductibles can apply per policy or per claim depending on the insurer and the type of policy. Policies with very high deductibles are typically less expensive because the high out-of-pocket expense generally results in fewer small claims. Number 2, premium. A policy's premium is its price, typically expressed as a monthly cost. The premium is determined by the insurer based on your or your business's risk profile, which may include creditworthiness. Number 3, policy limit. The policy limit is the maximum amount an insurer will pay under a policy for a covered loss. Maximus may be set per period, such as annual or policy term, per loss or injury, or over the life of the policy, also known as the lifetime maximum. Typically, higher limits carry higher premiums. For a general life insurance policy, the maximum amount the insurer will pay is referred to as the face value, which is the amount paid to a beneficiary upon the death of the insured. Insurance companies. Insurance companies may sell any combination of insurance types but are often classified into 3 groups. Number 1, life insurance companies, which sells life insurance, annuities, and pensions product and bear similarities to asset management business. Number 2, non-life or property casualty insurance companies, which sells other type of insurance. Number 3, health insurance companies, which sometimes sells life insurance or employee benefit as well. General insurance companies. General insurance companies can be further divided into these subcategories. Number 1, standard lines, and number 2, excess lines. In most countries, life and non-life insurers are subject to different regulatory regimes and different tax and accounting rules. The main reason for the distinction between the 2 types of company is that life, annuity, and pension business is very long-term in nature. Coverage for life insurance or a pension can cover risks over many decades. By contrast, non-life insurance usually covers a shorter period, such as 1 year. Mutual versus proprietary insurance companies. Insurance companies are generally classified as either mutual or proprietary companies. Mutual companies are owned by the policyholders, whereas proprietary insurance companies are owned by the shareholders who may or may not own policies. Reinsurance companies. Reinsurance companies are insurance companies that sell policies to other insurance companies, allowing them to reduce their risk and protect themselves from substantial losses. The reinsurance market is dominated by a few very large companies with huge reserves. A reinsurer may also be a direct writer of insurance risk as well. Captive insurance companies. Captive insurance companies may be defined as limited purpose insurance companies established with the specific objective of financing risk emanating from their parent group or groups. This definition can sometimes be extended to include some of the risks of the parent company's customers. In short, it is an in-house self-insurance vehicle. Captives as component of risk management. Captives are becoming an increasingly important component of the risk management and risk financing strategy of their parent. This can be understood against the following background. Number 1, heavy and increasing premium costs in almost every line of coverage. Number 2, difficulties in ensuring certain types of virtuous risk. Number 3, differential coverage standards in various parts of the world. Number 4, rating structures which reflect market trends rather than individual loss experience. Number 5, insufficient credit for deductibles or loss control efforts. Insurance consultants. There are also companies known as insurance consultants. Like a mortgage broker, these companies are paid a fee by the customer to shop around for the best insurance policies among many companies. However, with insurance brokers, the fee is usually paid in the form of commission from the insurer that is selected rather than directly from the client. Neither insurance consultant nor insurance brokers are insurance companies, and no risks are transferred to them in insurance transactions. Financial stability and rating. The financial stability and strength of an insurance company should be a major consideration when buying an insurance contract. Insurance companies are rated by various agencies such as AM Best. The ratings include the company's financial strength, which measures its ability to pay claims. It also rates financial instruments issued by the insurance company, such as bonds, notes, and securitization products. Types of insurance. Gap insurance. Gap insurance covers the excess amount on your auto loan in an instance where your insurance company does not cover the entire loan. Depending on the company's specific policies, it might or might not cover the deductible as well. Gap insurance is typically offered by a finance company when the vehicle owner purchases their vehicle, but many auto insurance companies offer this coverage to consumers as well. Types of insurance. Vehicle insurance. Vehicle insurance protects the policyholders against financial loss in the event of an incident involving a vehicle they own, such as in a traffic collision. Coverage typically includes: number 1, property coverage for damage to or theft of the car. Number 2, liability coverage for the legal responsibilities to others for bodily injury or property damage. Number 3, medical coverage for the cost of treating injuries, rehabilitation, and sometimes lost wages and for general expenses. Types of insurance. Health insurance. Health insurance policies cover the cost of medical treatments. Dental insurance, like medical insurance, protects policyholders for dental costs. In most developed countries, all citizens receive some health coverage from their governments, paid through taxation. In most countries, health insurance is often part of an employer's benefit. Types of insurance. Income protection insurance. Disability insurance policies provide financial support in the event of the policyholders becoming unable to work because of disabling illness or injury. It provides monthly support to help pay such obligations as mortgage, loans, and credit cards. Short-term and long-term disability policies are available to individuals, but considering the expense, long-term policies are generally obtained only by those with at least six-figure incomes, such as doctors, lawyers, etc. Short-term disability insurance covers a person for a period typically up to 6 months, paying a stipend each month to cover medical bills and other necessities. Types of insurance. Long-term disability insurance covers an individual's expense for the long term up until such time as they are considered permanently disabled, and thereafter insurance companies will often try to encourage the person back into employment in preference to and before declaring them unable to work at all and therefore totally disabled. Disability overhead insurance allows business owners to cover the overhead expense of their business while they are unable to work. Total permanent disability insurance provides benefit when a person is permanently disabled and can no longer work in their profession, often taken as an adjunct to life insurance. Workers' compensation insurance replaces all or part of a worker's wages lost and accompanying medical expenses incurred because of a job-related injury. Types of insurance. Casualty insurance. Casualty insurance insures against accidents not necessarily tied to any specific property. It is a broad spectrum of insurance that a number of other types of insurance could be classified, such as auto, workers' compensations, and some liability insurance. Types of casualty insurance. Crime insurance is a form of casualty insurance that covers the policyholders against losses arising from the criminal acts of third parties. For example, a company can obtain crime insurance to cover losses arising from the theft or embezzlement. Terrorism insurance provides protection against any loss or damage caused by terrorist activities. Kidnap and ransom insurance is designed to protect individuals and corporations operating in high-risk areas around the world against the perils of kidnap, extortions, wrongful detentions, and hijacking. Political risk insurance is a form of casualty insurance that can be taken out by businesses with operations in countries in which there is a risk that revolution or other political conditions could result in a loss. Types of insurance. Life insurance. Life insurance provides a monetary benefit to a descendant's family or other designated beneficiaries and may specifically provide for income to an insured person's family, burial, funeral, and other final expenses. Life insurance policies often allow the option of having the proceeds paid to the beneficiary either in a lump sum cash payments or an annuity. In most states, a person cannot purchase a policy on another person's without their knowledge. Types of insurance. Burial insurance. Burial insurance is a very old type of life insurance which is paid out upon death to cover final expenses, such as the cost of a funeral. The Greeks and Romans introduced burial insurance c. 600 CE when they organized guilds called benevolent societies, which cared for the surviving families and paid funeral expenses of members upon death. Guilds in the Middle Ages served a similar purpose as did friendly societies during Victorian times. Types of insurance. Property. Property insurance provides protection against risk to property, such as fire, theft, or weather damage. This may include specialized forms of insurance, such as a fire insurance, flood insurance, earthquake insurance, home insurance, inland marine insurance, and boiler insurance. The term property insurance may, like casualty insurance, be used as a broad category of various subtypes of insurance, some of which are listed below. Types of property insurance. Aviation insurance protects aircraft hulls and spares and associated liability risks such as passenger and third-party liability. Airports may also appear under this subcategory, including air traffic control and refueling operations for international airports through the smaller domestic exposures. Types of property insurance. Boiler insurance, also known as boiler and machinery insurance, or equipment breakdown insurance, insures against accidental physical damage to boilers, equipment, or machinery. Types of property insurance. Builder's risk insurance insures against the risk of physical loss or damage to property during construction. Builder's risk insurance is typically written on an all-risk basis covering damage arising from any cause, including the negligence of the insured, not otherwise expressly excluded. Building risk insurance is coverage that protects a person's or organization's insurable interest in materials, fixtures, or equipment being used in the construction or renovation of a building or structure should those items sustain physical loss or damage from an insured peril. Types of property insurance. Crop insurance may be purchased by farmers to reduce or manage various risks associated with growing crops. Such risks include crop loss or damage caused by weather, hail, drought, frost damage, pests including especially insects, or diseases, some of these being term named perils. Index-based insurance uses models of how climate extremes affect crop production to define certain climate triggers that, if surpassed, have high probabilities of causing substantial crop loss. When harvest losses occur associated with exceeding the climate trigger threshold, the index-insured farmer is entitled to a compensation payment. Types of property insurance. Earthquake insurance is a form of property insurance that pays the policyholder in the event of an earthquake that causes damage to the property. Most ordinary home insurance policies do not cover earthquake damage. Earthquake insurance policies generally feature a high deductible. Rates depends on location and hence the likelihood of an earthquake as well as the construction of the home. Types of property insurance. Fidelity bond is a form of casualty insurance that covers policyholders for losses incurred as a result of fraudulent acts by specified individuals. It usually insures a business for losses caused by the dishonest acts of its employees. Types of property insurance. Flood insurance protects against the property loss due to flooding. Many U.S. insurers do not provide flood insurance in some parts of the country. In response to this, the federal government created the National Flood Insurance Program, which serves as the insurers of last resort. Types of property insurance. Home insurance, also commonly called hazard insurance or homeowners insurance, often abbreviated in the real estate industry as HOI, provides coverage for damage or destruction of the policyholder's home. In some geographical areas, the policy may exclude certain types of risks such as flood or earthquake that require additional coverage. Maintenance-related issues are typically the homeowner's responsibility. In some countries, insurers offer a package which may include liability and legal responsibility of injuries and property damage caused by members of the households, including pets. Types of property insurance. Landlord insurance covers residential or commercial property that is rented to tenants. It also covers the landlord's liability for the occupants at the property. Most homeowners insurance, meanwhile, cover only owner-occupied homes and not liability or damages related to the tenants. Types of property insurance. Marine insurance and marine cargo insurance covers the loss or damage of vessels at sea or on inland waterways and of cargo in transit, regardless of the method of transit. When the owner of the cargo and the carrier are separate corporations, marine cargo insurance typically compensates the owner of cargo for losses sustained from fire, shipwreck, etc., but excludes losses that can be recovered from the carrier or the carrier's insurance. Many marine insurance underwriters will include time element coverage in such policies, which extends the indemnity to cover loss or profit and other business expenses attributable to the delay caused by a covered loss. Types of property insurance. Renter's insurance, often called tenant's insurance, is an insurance policy that provides some of the benefits of homeowner's insurance, but does not include coverage for the dwelling or structure with the exception of small alterations that a tenant makes to the structure. Types of property insurance. Supplemental natural disaster insurance covers specified expenses after a natural disaster renders the policyholder's home uninhabitable. Periodic payments are made directly to the insured until the home is rebuilt or a specified time period has elapsed. Types of property insurance. Surety bond insurance is a three-party insurance guaranteeing the performance of the principal. Volcano insurance is a specialized insurance protecting against damage arising specially from volcanic eruptions. Windstorm insurance is an insurance covering the damage that can be caused by wind events such as hurricanes. Types of insurance. Liability. Liability insurance is a very broad superset that covers legal claims against the insured. Many types of insurance includes an aspect of liability coverage. For example, a homeowner's insurance policy will normally include liability coverage which protects the insured in the event of the claim brought by someone who slips and falls on the property. Automobile insurance also includes an aspect of liability insurance that indemnifies against the harm that a crashing car can cause to others' lives, health, or property. Liability protection. The protection offered by a liability insurance policy is number 1, a legal defense in the event of a lawsuit commenced against the policyholders, and number 2, indemnification payment on behalf of the insured with respect to a settlement or court verdict. Number 3, liability policies typically covers only the negligence of the insured and will not apply to the results of willful or intentional acts by the insured. And number 4, public liability insurance or general liability insurance covers a business or organization against claims should its operations injure a member of the public or damage their property in some way. Types of liability insurance. Directors and officers liability insurance or D&O protects an organization, usually a corporation, from costs associated with litigation resulting from errors made by directors or officers for which they are liable. Environmental liability or environmental impairment insurance protects the insured from bodily injury, property damage, and cleanup costs as a result of the dispersal, release, or escape of pollutants. Types of liability insurance. Errors and omissions insurance or E&O is business liability insurance for professionals such as insurance agents, real estate agents and brokers, architects, third-party administrators or TPAs, and other business professionals. Price indemnity insurance protects the insured from giving away a large prize at a specific event. Examples would include offering prizes to contestants who can make a half-court shot at a basketball game or a hole-in-one at a golf tournament. Types of liability insurance. Professional liability insurance, also called professional indemnity insurance or PI, protects insured professionals such as architectural corporations and medical practitioners against potential negligence claims made by their patient or clients. Professional liability insurance may take on different names depending on the professions. For example, professional liability insurance in a reference to the medical profession may be called medical malpractice insurance. Types of credit insurance. Credit insurance repays some or all of a loan when the borrower is insolvent. Mortgage insurance insures the lender against default by borrower. Mortgage insurance is a form of credit insurance, although the name credit insurance more often is used to refer to policies that cover other kinds of debt. Many credit cards offer payment protection plans, which are a form of credit insurance. Trade credit insurance is business insurance over the accounts receivable of the insured. The policy pays the policyholder for covered accounts receivable if the debtor defaults on payment. Collateral protection insurance or CPI insures property, primarily vehicles, held as collateral for loans made by lending institutions. Types of insurance. Cyber attack insurance. Cyber insurance is a business line's insurance product intended to provide coverage to corporations from internet-based risks and more generally from risks relating to information technology infrastructure, information privacy, information governance liability, and activities related thereto. Types of insurance. All-risk insurance. All-risk insurance is an insurance that covers a wide range of incidents and perils, except those noted in the policy. All-risk insurance is different from peril-specific insurance that covers losses from only those perils listed in the policy. In car insurance, all-risk policy includes also the damages caused by the own driver. Types of insurance. Bloodstock insurance. Bloodstock insurance covers individuals' horses or a number of horses under common ownership. Coverage is typically for mortality as a result of accident, illness, or disease, but may extend to include infertility, in-transit loss, veterinary fees, and prospective fall. Types of insurance. Business interruption insurance. Business interruption insurance covers the loss of income and the expenses incurred after a covered peril interrupts normal business operations. Types of insurance. Defense-Based Act or DBA insurance. Defense-Based Act DBA insurance provides coverage for civilian workers hired by the government to perform contracts outside the United States and Canada. DBA is required for all U.S. citizens, U.S. residents, U.S. green card holders, and all employees or subcontractors hired on overseas government contracts. Depending on the country, foreign nationals must also be covered under DBA. This coverage typically includes expenses related to medical treatment and loss of wages, as well as disability and death benefits. Types of insurance. Expatriate insurance. Expatriate insurance provides individuals and organizations operating outside of their home country with protection for automobiles, property, health, liability, and business pursuits. Types of insurance. Hired-in plant insurance. Hired-in plant insurance covers liability where under a contract of hire the customer is liable to pay for the cost of hired-in equipment and for any rental charges due to a plant hire firm, such as construction plant and machinery. Types of insurance. Legal expenses insurance. Legal expenses insurance covers policyholders for the potential costs of legal action against an institution or an individual. When something happens which triggers the need for legal action, it is known as the event. There are two main types of legal expenses insurance: before the event insurance and after the event insurance. Types of insurance. Livestock insurance. Livestock insurance is a specialist policy provided to, for example, commercial or hobby farms, aquariums, fish farms, or any other animal holding. Cover is available for mortality or economic slaughter as a result of accident, illness, or disease, but can extend to include destruction by government order. Types of insurance. Media liability insurance. Media liability insurance is designed to cover professionals that engage in film and television production and print against risks such as defamation. Types of insurance. Nuclear incident insurance. Nuclear incident insurance covers damages resulting from an incident involving radioactive materials and is generally arranged at the national level. See the Nuclear Exclusion Clause and for the United States, the Price-Anderson Nuclear Industries Indemnity Act. Types of insurance. Pet insurance. Pet insurance insures pets against accidents and illness. Some companies cover routine wellness care and burial as well. Types of insurance. Pollution insurance. Pollution insurance usually takes the form of first-party coverage for contamination of insured property either by external or on-site sources. Coverage is also afforded for liability to third parties arising from contamination of air, water, or land due to the sudden and accidental release of hazardous materials from the insured site. The policy usually covers the cost of cleanup and may include coverage for releases from underground storage tanks. Intentional acts are specifically excluded. Types of insurance. Purchase insurance. Purchase insurance is aimed at providing protection on the products people purchase. Purchase insurance can cover individual purchase protection, warranties, guarantees, care plans, and even mobile phone insurance. Such insurance is normally very limited in the scope of problems that are covered by the policy. Types of insurance. Tax insurance. Tax insurance is increasingly being used in corporate transactions to protect taxpayers in the event that a tax position it has taken is challenged by the IRS or a state, local, or foreign taxing authority. Types of insurance. Title insurance. Title insurance provides a guarantee that title to real property is vested in the purchaser or mortgagee. Free and clear of liens or encumbrances, it is usually issued in conjunction with the search of the public records performed at the time of a real estate transactions. Types of insurance. Travel insurance. Travel insurance is an insurance cover taken by those who travel abroad, which covers certain losses such as medical expenses, loss of personal belongings, travel delay, and personal liabilities. Types of insurance. Interest rate insurance. Interest rate insurance protects the holder from adverse changes in interest rates, for instance, for those with a variable rate loan or mortgage. Types of insurance. Divorce insurance. Divorce insurance is a form of contractual liability insurance that pays the insured a cash benefit if their marriage ends in divorce. Types of insurance. No-fault insurance. No-fault insurance is a type of insurance policy, typically automobile insurance, where insured are indemnified by their own insurer regardless of fault in the accident. Types of insurance. Protected self-insurance. Protected self-insurance is an alternative risk financing mechanism in which an organization retains the mathematically calculated cost of risk within the organization and transfers the catastrophic risk with specific and aggregate limits to an insurer, so the maximum total cost of the program is known. A properly designed and underwritten protected self-insurance program reduces and stabilizes the cost of insurance and provides valuable risk management information. Types of insurance. Retrospectively rated insurance. Under this plan, the current year's premium is based partially or wholly on the current year's losses, although the premium adjustments may take months or years beyond the current year's expiration date. The rating formula is guaranteed in the insurance contract. Formula: retrospective premium is equal to converted loss plus basic premium whole multiplied by tax multiplier. Numerous variations of this formula have been developed and are in use. Types of insurance. Formal self-insurance or active risk retention. Formal self-insurance is the deliberate decision to pay for otherwise insurable losses out of one's own money. This can be done on a formal basis by establishing a separate fund into which funds are deposited on a periodic basis, or by simply foregoing the purchase of available insurance and paying out of pocket. Self-insurance is usually used to pay for high-frequency, low-severity losses. Types of insurance. Reinsurance. Reinsurance is a type of insurance purchased by insurance companies or self-insured employers to protect against unexpected losses. Financial reinsurance is a form of reinsurance that is primarily used for capital management rather than to transfer insurance risk. Types of insurance. Social insurance. Social insurance can be many things to many people in many countries, but a summary of its essence is that it is a collection of insurance coverages, including components of life insurance, disability income insurance, unemployment insurance, health insurance, and others, plus retirement savings that requires participation by all citizens. By forcing everyone in society to be a policyholder and pay premium, it ensures that everyone can become a claimant when or if they need to. Types of insurance. Stop-loss insurance. Stop-loss insurance provides protection against catastrophic or unpredictable losses. It is purchased by organizations who do not want to assume 100% of the liability for losses arising from the plans. Under a stop-loss policy, the insurance company becomes liable for losses that exceed certain limits called deductibles. Dear viewers, you are watching course number 6, Insurance and its Types, on YouTube channel ETV 786. Thank you for watching basic concepts of accounting, business law, business taxes, business management, and business mathematics on this channel. Please view, like, share, and comment the videos, and subscribe the channel to view upcoming lectures. Bye bye till the next show.